Okay, in finishing, Kylie, and this is, I don't know if I sent you this one. I think I did, Phil. This is a juicy one to finish on. I would be interested in some tips and methods to compare life insurance policies from both a cost and coverage perspective offered by key industry super funds with comparison to private offerings. How can we ensure we're comparing apples with apples, so to speak? Well, you can't, so there's that. Also, or can you? You probably can't. Also, there are any review platforms you would recommend to check out these income TBD death insurance policies in relation to how easy/problematic various insurers are to claim from. I understand that at least one super fund, from memory CBUS, has been disciplined for the excessive length of time they take to assess and process claims. So a bit there. I had a client once, they died and it took CBUS over 6 months to write the insurance check and to pay the actual death benefit of the account. And to be frank, it's actually disgusting when it's an open shut claim. So that's just a comment.
Shout out to CBUS.
Yeah, shout out. Shout out to the super company that will never want to work with Glen James.
Yeah. And their premiums are wildly expensive, but that's okay. All right, let me tackle this question. All right, in two pieces. So the comparison websites, unfortunately, all these comparison websites for everything, the way they make money is that they clip the ticket, so they'll get paid a referral fee. Within insurance policies, within super funds, they're not paying those comparison websites a referral fee. So therefore, there's no comparison website that's going to be built. So I Select, they make money from car insurance providers paying them when you click through and you get on their database and you get called 1 million times. And health funds, all of the same thing. When it comes to insurance policies within a super fund, to be honest, it's even more difficult because you often need to be a member of that super fund to then get a quote with that super fund to understand what their cost is going to be. So unfortunately, the answer is really you've got to be a financial advisor.
Okay, just a question. I thought, full disclosure, everyone, I have not opened a industry fund PDS for maybe over 8 years. There used to be insurance tables where you could just work out per 1,000 units the costs for the age and gender.
Some super funds do that, yeah.
But some are not having that publicly in their PDS?
Exactly, yeah.
Gosh,
not all of them have those tables.
This is why you just need to go to a freaking financial advisor, everyone.
Anyway, what's even worse is some super funds don't even allow you to look at their insurance kind of guide or PDS. It's not really a PDS, but it's an insurance guide. You can't even get that guide unless you're a member and you can log in. And so as advisors, if we don't know information about a super fund's insurance guide, we've got to call them up and get authority on our clients' accounts to call up and get that information sent to us. It's like, why isn't this publicly available?
Yeah, I used to just get the PDS and go, $1 million per 1,000 units. There's the price, done.
You just go across, easy days. But so as advisors, we subscribe to software that's their business model is to sell to advisors to be able to compare all these policies. So we can do it. Now, that doesn't help anyone because we charge a fee to do all that work and all this hoo-ha. But unfortunately, there is no comparison website where you can self-select and go and do it without a huge body of work. And that's just the way it is. And even comparing apples to apples for a consumer is almost impossible to do because you've got to actually read through the PDS.
But the problem is, Phil, the default insurance and the additional group insurance, and we'll just call it death cover, right, in super, that's an orange, and every insurance policy you get with a financial advisor is also an apple. There are not, because the policies inherently are different. Guaranteed renewable, is one example.
And again, what even makes it more complex, like a finder.com, you can go to them, but their insurance policies that they offer are not through super funds, they're direct offerings. And even those ones, like Real Insurance is one that they will offer. I looked at it a few months ago, they're probably still there. That's actually distributing a specific policy that Tao, who's the actual insurance company, distribute through Real Insurance. So it's not Real Insurance who's offering the cover, it's actually TAL. And that's a very specific offering that Real Insurance is organised with TAL to customise their products. And so when you go into a finder, you're only going to look at those direct offerings that are distributed through third parties, and you can't even, and so sometimes you'll get like feature scores in the finder.com kind of comparison websites when it comes to like health insurance and stuff. But long story short, it's impossible to not impossible, it's very difficult to self-select and self-educate in the life insurance space. And that's unfortunate because I would love people to be able to do this stuff and we just be a value add in that space. Unfortunately, the way it's built in Australia is financial advisors are kind of the gatekeeper of this, not because we want to be gatekeepers, but because that's the way it's created from a I won't go into too much detail.
Well, no, but it all goes back to distribution.
Yes, but it's also the way the legislation is life insurance is a financial product.
Yes, and you need financial product advice.
Yes, and it has to be distributed through financial advice if it's a financial product. So that's why it's a little bit difficult.
Now, I will say
there was a second part of this question.
Oh yeah, go for it. You go that, and then I'll finish with my rant.
So claims is the next question. How do we find about problematic claims experiences? So ASIC they run a Money Smart website. So you can Google insurance claims Money Smart, and they've got claims tables in there. So you can actually look at it from super funds. I've got life insurance through a super fund, and then you can see the insurers. The difficulty there is if your super fund's with, let's say, Australian Super, it won't say Australian Super because they're not the actual insurer. So you've got to read TAL. Now, TAL, they insure CBUS and Australian Super. So it is difficult to really get a clear understanding of if CBUS is any good or no good.
I'm on the site now, and I've just gone in, compare life insurance, death cover through a financial advisor. The claims accepted rate, industry average is 97.2, which basically means if you get the death policy from a financial advisor, it will pay, basically.
Yeah, and look, Superfund, the statistics are actually really interesting, and I could geek out for a long time. Superfunds actually have a higher claims acceptance rate.
98.4 for superfunds. But that's because of the nature of the group policy, right? And the default automatic acceptance.
That is one reason. Another reason is the super fund can actually block the claim from moving forward. So with these data, this data has to go to APRA. So all insurers have to send this data to APRA. So if you submit a claim with TAL through a financial advisor, even if you filled out one form, they have to log that as the claims lodged. And if you don't get any documentation to them after that, the claim will then officially get declined, and therefore it goes. With a super fund, and I've spoken to a lot of super fund executives about how they manage it, if you don't provide all the documentation to lodge the claim, they won't send that on to TAL. So therefore that's why claims acceptance rates can sometimes be a bit funky there.
Well, that was with the issues with CBUS. It's like, it's got to go to a trustee meeting and they don't meet for 6 weeks. And it's like, that's cute. I've got a widow here with no money. So anyway.
Exactly.
Here's a funny thing. I've just so there's the three things: a sales channel through a financial advisor and industry fund. Now there's through an insurance company direct. Now it's got the list of the insurance companies. And a lot of these will be out there in the wild that are badged, for example, as you said about Real Insurance. The industry average direct, when you call your daytime TV rubbish ad, is 92%. So even just going to
life insurance.
For life insurance.
That's someone dead.
Yeah.
It's pretty binary.
No, but that's when we haven't disclosed, and it's got to be
correct.
All that stuff.
No, I know why. The numbers are there, but theoretically, life insurance should be.
But that's what I said. 9%. Like if you go to a financial advisor or an industry super fund, given this data, you're going to get a claim paid for death. At 92, I'm not maybe hanging my hat on that, but one of the reasons that anyone listening on this side of the planet can't get life insurance and just death cover only, your daytime TV crap or your finder.com link to real insurance. And if it sounds like I'm being critical of real insurance and comparison websites, it is because I am. Number one, they inherently will give you a death policy set up in your own name. Now, what that means is, number one, you pay that money from your bank account. It is not tax deductible. You should not, unless there's extreme circumstances, have a death policy in your own name in Australia. Have it in a super fund because the super fund claims the premium on tax, aka tax deductible, and there's no tax on death benefits in Australia. My next rant is a policy in your own name. If you've got a blended families and all that, it's not tax deductible in your own name. And number two, you've got no real solid control with the estate planning of it because if the money falls into your estate. At least if it's set up in super, it's tax deductible, the benefits tax-free, and you can put a binding nomination that it goes to your freaking child so your stepson little turd doesn't get any mitts on it. Anyway,
there's a lot more
here.
controls.
Yeah.
Can I just quickly touch on those claims numbers? So one of the things I don't love about those claims numbers is when it comes to the super funds, you don't actually know which super fund is influencing those numbers. Number two is there are a lot of insurers that don't show their data, and the reason being is because these numbers are only a 12-month window in time, and some of them won't have enough claims accepted in that period of time. And so APRA don't show the numbers if the numbers aren't statistically significant. So it needs to be over 100 claims in any one of these categories. So what I would love APRA to change is give us a 5-year window on claims. So then every insurer will show there won't be any, finalised claims are too small to provide the results. So we can actually see over a period of time, what are we seeing? But I'm not changing APRA's mind on these things, unfortunately.
How fun is this? Income protection insurance directly through a super fund, 96.3, and this was last financial year ending 30 June 2025. We're recording this at the start of Feb, basically in 2026. Income protection insurance through a super fund, 96.3, the industry average. Direct through a financial advisor is 94.4, so less claim acceptance rate. However, you're not necessarily going to run direct to the group cover because it's got a 2-point increase in acceptance rate because it's probably going to be more expensive and it's going to be a crapper policy.
Yeah.
Now, get this. This is the wild thing. Directly through an insurer. Oh, real insurance. I don't even know if they provide IP anymore. 86% industry average for direct. The policy is going to be crapper. They're probably not giving you to an age 60 benefit period. They won't do the medical underwriting up front a lot of the time. Like, what are we doing here, everyone? What are we doing?
The other thing I would love to see in these numbers, and I've done my own research because APRA actually publish all of these stats publicly, and so I can look at it all because I'm an insurance geek and I do look at it all. Is I would love APRA to show the average claim amount, and that would really show a really clear indication that the average claim amount for something like life insurance is $134,000 for super funds. And it's over $500,000 through a financial advisor. And that is a real measurable difference for all of these thousands of people making a claim is actually the level of cover. Whether I wait 0.4 of a month longer for that claim or not is nothing compared to an extra $500,000 in my bank account.
Now, I will say as well, you've got to take all these numbers with some plus or minus tolerances in the real world because, Phil, if I have an income protection policy and I get fired and I lodge a claim, they're going to decline it because I'm not covered for loss of a job. It's for accident and illness only. So that goes into the data. If I hurt my knee at soccer and I'm off work for 3 months and I contact my super fund and go, I'm going to put a claim in for TPD insurance on my knee at soccer because I'm off work for 3 months, that's going to be a straight up decline. And that's going to be in the data.
And this is why when people are like, well, why isn't life insurance 100% acceptance? Well, okay, there are terminal illness options where we might make a terminal illness claim that's a life policy, and that may get declined because we haven't met those definitions yet.
Yeah.
Well, yeah, exactly. So, yes, theoretically things should be 100%, but no, it isn't because of these nuances. So, yeah, we don't rely on this and say we are never going to recommend this one because they're much worse. But we push on the insurers as an advice firm. We're constantly asking the insurers because we actually have these stats in our advice document just to be as transparent as possible. And so we push on the insurers. Actually, you guys are pretty low in the last 12 months. What's going on? Pull your heads in.
Yeah. Love it. And that's it. Like you could look at this Money Smart website and see that last financial year through a financial advisor, income protection insurance, the highest claim rate is Noble Oak, 97.4.
Yep.
You could go to Skye Wealth and go, hey, I want insurance. I just want Noble Oak. They'll be like, sure, whatever. It's costs more than what we're going to recommend, but knock yourself out. This is like investment returns. This was only last 12 months. You don't look at the last 12 months of performance for your super fund. You need to step back and look, okay, what's the bastard done over the long term of 7 years? That's what matters.
Yeah.
But also, if you want to go to Phil's business and say, we only want, I don't know, Resolution Life or TAL because they've been a show partner on the podcast or they've got a high rate, they'll be like, yeah, sure, whatever. It's more expensive and you get an exclusion where we can put it over here with old mate and it's a little bit cheaper without an exclusion. Knock yourself out.
Yeah, exactly. And that's right. It's just about educating and empowering clients to make their decision. And if they want to rely on this, we'll encourage them, hey, take it with a grain of salt. Here's the reality. But at the end of the day, it's not my policy. I'm not paying the premiums. Exactly.
Now, that last 20 minutes was fully beyond the scope of any Retire Right podcast I've ever planned on the planet. But here you go. You're there. Phil Thompson from Skye Wealth. If anyone's got a situation where they don't have any insurance and are still carrying debt and are still going to be working for the next 10 years and they've got dependents, they've got to go to Skye Wealth, yeah?
Yep.
You know, this is an ad, everyone. Assume anything that drips out of my mouth is an ad. If I talk about pet insurance, I'm advertising pet insurance. Even if I'm not, just assume everything's an ad if you're listening to this show. If you've got cover like Mira and you want it reviewed, reach out to Skye. They may charge you to review the cover and give you an advice document, but if you want a professional, you've got to pay for a professional.
Yep.
Anything else you want to add, Philip?
No, I mean, yeah, you can just go on our website and book a phone call with the advisor. That's 15 minutes. We don't charge for that.
Oh, you just run the flag up the pole and see.
And that can just be hey, we just want to chat. And then, you know, our team will talk about what our process is. We can't say, oh, yeah, go cancel that cover over the phone. It needs to be done via financial advice. But if there are just basic questions, we're happy to help anyone in the Retire Right community.
And often if someone's got an advisor already linked to a policy, you'd probably say, why don't you go back to your advisor? They'll probably review this in terms of what they're already receiving.
Yeah, we always tell anyone who comes to us, and if they've got an advisor with the policy, we'll always say, hey, go to them first. They're maybe the best way, you know, because they know what levels of cover you've got and why they set it up that way. We don't. We'll have to do all of that investigation. And so we charge for that, and they may not charge for it. So, yeah, always reach out. If you've got an advisor, go to them first.
Love it. Phil Thompson from Skye Wealth, thank you so much for joining us today. Remember, everyone, you only retire once, so retire right. If this has been of value, please send it to a friend or family member. And if you are still watching on YouTube, I know that you have a 40% chance of not being a subscriber. So why don't you click that subscribe? Thank you so much. We'll see you soon. Bye.